Options Trading for Beginners, the ultimate in-depth guide.
Super deep on implied volatility in this video. I do have many other videos in my channel, and I will link my most recent one below so that you can get a full deep dive into implied volatility. I think it's an incredibly important topic for you to understand, but I wanted to bring it up because when we are trading options, we can make money or we can lose money from the changes in the stock price. We can also make or lose money.
So making money and losing money to the changes of the stock price is delta, right? Remember delta. What delta means is for every $1 change in the underlying stock price, the option will change by that amount. So let's go over here, delta right here. And Georgia was just asking, is 87 delta too high? Well, it doesn't have to be, right? Like this one right here at 80 delta, 88 delta, it's got lots of open interest. The extrinsic value is really low. The price has a pretty tight bid-ask spread. There's nothing wrong with that, right? Especially, Georgia, if you're looking around and let's imagine that all of these were like 50, 60s all the way down. And if that's the only one that has a ton of liquidity, that's exactly where I would go. Not too high to me. Not too high to me. So, so that's what delta is over there. Let's see if he's going to add more to that.
From the passage of time, which is quite literally the extrinsic value or time value coming out of the options.
Now, extrinsic value, time value. Remember, extrinsic value goes to zero on every stock, every time, every strike. Doesn't matter. It will always go to zero. Let's look at the difference between, this is Celsius here. We closed this one yesterday. Let's look at the difference between Celsius, July 18th, which is 16 days out, and July 3rd, which is tomorrow. Okay, the extrinsic value, let's just go for like the 45 strike. It's $1.41 here. And the 45 strike is 28 cents here. Pretty cool, right? Now, it's going to zero. It is going to zero. Let me show you what that looks like as a chart. It is going to zero. It is going to zero. You can choose to be deep in the money, like Georgia was talking about, which is how I trade, way up here. And that is a pretty linear curve all the way down. Or you can be out of the money or even at the money. And most of that pricing is extrinsic value here. And this goes on a very hard, very sharp decline all at once, right? All at once, it's going doop, 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 cliff, right? Now, also keep in mind, if you are trading deep in the money, and let's say 13% of the price is extrinsic, because the extrinsic plus the intrinsic makes up your total option price. Intrinsic is calculated from the price of the stock minus the strike price. So in this case, the $46 stock minus minus the 45 strike is going to give you $1 of intrinsic value. But the price of the option is not $1. The price of the option is between $1.20 and $1.37. So midpoint of this would be $1.28, which would be your extrinsic value here. Intrinsic and extrinsic. Intrinsic, we want to maximize. Extrinsic, we want to minimize. So in this case, looking at this, right, if both of these two options have extrinsic value, yet one of them is 13% extrinsic, and let's say that it's 16 days to expiration. So 13 divided by 0.13 divided by 16 means times 100. 0.81% of this will decline per day in extrinsic value. So 81 basis points per day of your total option value, less than 1% per day, will decline over time, okay? But let's say if it's 100% divided by 16 days, that means 6.25% of it will decay each day. So for me, I'm looking at it where I only have less than 1% of decay each day, where people who trade out of the money are looking at 6 times that much decaying each day. All right. So deep options theory to start off here. This is why it's called Options Deep Dive Wednesdays.
But we can also make or lose money in options trading from a change in implied volatility. And a change in implied volatility quite literally means that the option prices are changing.
Okay. So the change in implied volatility, when we look at this, remember, extrinsic and intrinsic are the two values that make up the price of the option. Okay. So remember, just 30 more seconds of explanations. The current price of $46 minus your strike price, if you have the 45 strike, minus 45 gives you $1 of intrinsic value. That will not change. That will not change. The only way this changes is what the price of the stock changes, okay? Because remember, it's A minus B, A minus B. Now, the other thing that can change is the extrinsic value. This is the uncertainty value. And we talked about how it will decay over time. However, if implied volatility expands, meaning the expected move expands, if the expected move, Rawl, I'm teaching this right now. Do you teach options in your Discord? I'm teaching it literally at this exact moment right now for free on YouTube. Listen, if you don't like it, there's a full 100% money back guarantee on this video right now. The extrinsic value is where that implied volatility is going to go, because remember, intrinsic is A minus B. So the only place that the prices can change based on the change in implied volatility is over here. Remember, time will tick down every single day. That is a certainty, right? We're all moving towards zero on this. However, if implied volatility were to expand, if the expected move were to expand, this is where it would go. Everybody got that? Let me know in the chat. Type "got that" in the chat if that makes sense. Type "got that" in the chat if this makes sense. The implied volatility has only one place to go, and that's in the extrinsic value. So this is also why I say I don't really stress on it. I don't really worry about it, because if the implied volatility expands and it only goes into the extrinsic value column, the only thing that changes for me is I just go further up the options chain. I just go further up the options chain is what it is. I don't stress on it, because in my trading plan, I'm trying to find where the extrinsic value is roughly 20% or less, give or take. My absolute max is 30%, but if I can hit 20, that's the sweet spot that I'm looking for. Extrinsic value would be 20% or so of the ask price. So 35 cents on 650. So the one Georgia was talking about earlier, the 40 strike here, 35 cents on 650 is 5%. Now imagine implied volatility is bumped up, and this is now $1.35, right? $1.35 is 20%, right? Same strike. The only thing that can change is the extrinsic value here if implied volatility expands. We're getting so deep today. I'm sure I have broken some brains by now, but we got lots of got that's, so that's good. Lots of got that's. Thank you guys. So if this expands, no big deal. Just roll up the options chain until you get the proportion of the stock of the option price of extrinsic to total price of 20% or less. Okay. So implied volatility expansion doesn't bother me, not in the least.
So in our Teladoc and Visa example, Visa's 180 call option was worth $7.35, and Teladoc's June 180 call option was over $15. So because of that, Visa's implied volatility is lower than Teladoc's. And what I'm saying by a change in implied volatility is that if the market learned of some new news related to Visa and they expected significantly more stock price movements from Visa in the future or through the June expiration cycle, let's say that options traders started to buy up those options aggressively. And because of that increased demand, the option prices in Visa would increase.
So what he's drawing here is basically the bell curve of things that can happen, right? Now, of course, we all have seen stocks that have had tremendous moves up, and we've all seen stocks that have had tremendous moves down that break this. Now, this model is based on the efficient market theory, which is just a theory, because the efficient market theory doesn't want to say, oh, you know what? A stock can definitely do this, right? Move way out of that expected move over and over and over again. These are stocks that I own right now, and each one of them looks like it could have potentially broken out of that expected move range, right? So because of this, the efficient market theory is just a theory. Let's go back to the video here. So imagine this is price today plus 1, today plus 2, today plus 3, right? But if you're in a big, beautiful trend, you got all the outlier 9 in your favor, you can see giant outsized moves that go way outside of this. But the implied volatility is, what is the expected range of move? And so here we can see what it would look like if it was, supposedly low, and here what it would look like if it's a higher movement here. Now, what causes this change, right? What causes this change? Do me a favor in the chat. What do you think would cause this implied volatility move, this implied volatility range to expand? It's really easy once you understand what you're looking for. Manny's brain is broken. Sorry, Manny. What would you expect to see happen for this implied volatility expansion? Greed is a really good answer, right? Why would people get more greedy, right? What's driving people to get more greedy? David has a really good question while y'all are typing that in. If you're in a trade and you need to roll to a later expiration date, would you be okay adding extrinsic value to your position? So if you're trying to roll from period to period and keep the same strike, It's very unlikely you'll be able to get a credit. Very unlikely. If you're rolling from the 40 strike out a week to the 40 strike, super unlikely you're going to take a credit because you're selling to close one that is lower in value because it has a lower extrinsic value, and then buying to open one further out in time that has mathematically a higher extrinsic value. But if you roll down, right, closer to the options chain or closer to the at the money. So if you go from the 40 to the 42, by doing so, you should be able to get a credit in that process. I can't guarantee that, but mathematically speaking, more than likely you'll be able to get the credit, and only roll if you're taking a credit. If you are rolling an option to lock in profits, to free up capital, and to keep the trade alive, if you're doing the roll and you pay a debit to do so, then you have actually added risk to the trade. So let's say if you bought it for $4, then you rolled it for 25 cents debit, your max loss went from $4 to $4.25 instantly, just like that. We don't want that, right? We want to be looking maybe to roll from $4 and take in 25 cents of credit, which means we have decreased our total max risk in the trade from $4 to $3.75. I don't know if you can tell right now. I know my shit. I know my shit. I love this. Okay. The light bulb just went off for Charlotte. Very good. Uncertainty, greater uncertainty. The original sin. I don't know if the original sin would do that, but greater uncertainty. Earnings. There you go. That was what I was looking for. Earnings. Things like earnings. Things like new product announcements, right? This always happens when Apple's going to release their newest iPhone, right? Implied volatility gets pumped up because nobody knows if the market's going to love it or hate it. Right. What earnings? Yeah, from David. Right. What's something else? Let me know in the chat. What do you think something else could be to cause that? Right. I think news stories that have potentially big outcomes. Right. So recently there was several news stories about drones. Right. Drone stocks, and so that could cause implied volatility to increase. Changes in CEOs could cause implied volatility to increase. Rumors, right? Gene, exactly. Rumors can cause implied volatility to increase. Shelf offerings, yep, like we dealt with yesterday. Fed meetings, that's a really good one, Ryan. Yeah, there's plenty of things, right? Splits could cause that. Corey says mergers could cause that. There's a million different things. Pelosi could cause that. Budget bills could cause that. Trump sitting on the toilet, right? Yeah. Jim Cramer, presidential tweets, yeah, all that kind of stuff could cause implied volatility to expand because that's added uncertainty, right? Company heads selling stock, like Brian says. Charlotte says, so if prices drive changes to IV, then it's anything that changes prices, i.e. Trump. It's more it's the tail wagging the dog versus the dog wagging the tail in this case, right? It's like, imagine that rumors are happening, right? That's the tail, and then the price is the dog, right? If rumors start getting out of control, that tail's going crazy, right? It's going to start moving the dog around. It's going to start moving the price, right? Tariffs, arguments with the POTUS, pharmaceutical breakthroughs, triple witching. There's lots of things that could cause that, right? And our job is not to worry about those things. Our job is to have a plan and execute the plan, right? So that's why I say implied volatility, it doesn't do much to me in my style of trading, because if implied volatility explodes, all I got to do is just move up the options chain. That's it. It's really not that difficult. But if you are an options seller, this will make or break you. And listen, as a reformed option seller, it made and broke me many times over. Oh my gosh. Let's keep going here.
Increase, meaning the extrinsic value or time value would increase in Visa's options. So if we hold the stock price to the same and we are looking at one single trading day, and Visa's call option with a strike price of 180 went from $7.35 to $15, that would be called an increase in implied volatility. And it is quite literally, the options are getting more expensive relative to the amount of time they have until expiration. And that tells us
they're getting more expensive because we just introduced a new level of uncertainty that we didn't have before.
That the market is expecting greater levels of volatility in the stock price going forward. So if I bought an option, so I bought that 180 call option for $7 and the news came out, but the stock price
news, okay, news event right here. By the way, Is this helpful that I can add my context to his original version? If it is, type in the chat helpful. Type in the chat helpful. I just want to know if this is worth your time, right? Because he's telling you all the theory, he's telling you all the textbook stuff, and I'm telling you all the stuff that I have lived with and learned from trading through this. Okay, lots of good helpfuls. Okay, very, very good. I did see one post from Chris up here. It's crazy how 4 months ago I didn't know what an options was, and now I can discuss it intelligently. Thank you, Chris. You rock. No, you rock, Crispy. You rock, Crispy. You're very crispy. Okay, cool. All right, let's keep going here. Thank you all for that feedback.
Stayed the same, and no time passed because we're looking at one trading day, and that 180 call option went from $7 or having a premium of $700 all the way up to $15 or having a premium of $1,500. Obviously, since I own that call option, an increase in its price is advantageous to me, and I will profit from that. So when you are buying options, you can make money from an increase in implied volatility, which literally means that the option prices are becoming more expensive because the market expects greater levels of volatility from that stock in the future.
Which, one of my very favorite trades, is to buy a stock as it's going into earnings. Because a lot of times stocks, if you've ever heard of buy the rumor, sell the news, I think someone even mentioned that earlier. Buy the rumor, sell the news is real, right? We can look at mini charts. I don't know if I can find an exact perfect version. Here you go, on PayPal, right? On PayPal right here. Earnings came on this candle right here, okay? Look how it ran. Now, granted, I wouldn't have traded this one because it was coming out of a downtrend, but from this bottom down here to here, it ran up 16% in 13 days. That's a buy the rumor, sell the news type of situation here, but people actually bought the news after that as well. So this is one of my all-time favorite trades to make, is buying up into earnings. Number one, because you can see this delta change, and the delta will be an impact to your intrinsic value, okay? So the intrinsic value is growing as it's going up, but what's also growing as it's going here up to earnings is implied volatility. And implied volatility is pumping up the extrinsic value. This is why trading into earnings is one of my favorite things to do. I don't want to trade at earnings. That's too much of a risk. But trading up into earnings, leading into earnings, we're taking the delta, we're making money on our intrinsic as it's going up. Then we're also making money on the extrinsic as that uncertainty is going up as well, leading up into earnings. Isn't that cool? This is why I like to trade that. Does that make sense?
But on the flip side, you can lose money from a decrease in implied volatility or a shrinking of option prices when you buy options. So if I bought a call option and the stock price didn't change, but all of a sudden the market expected significantly lower levels of volatility in the stock price going forward, the option prices, particularly the extrinsic value, would collapse. And because of that, I would lose money on the decrease in my call options extrinsic value because the.
But if you have designed your trade, if you've set up a trade in a way where you understand that the extrinsic value is going to go to zero, we know this. So we're trying to minimize how much extrinsic value we have to start with. Then that decline is inevitable. We know it's going to happen. It is a byproduct of trading this leveraged instrument that we cannot get around. We have to take a trade with extrinsic value. You will never, ever find a trade without extrinsic value. But if you structure it in a way where it's only a small portion of your trade overall, and then you're trading with the trend, the delta changes, the price changes should be greater than the implied volatility contraction. Man, we're getting really deep today. I apologize, but also I don't apologize. Sorry, not sorry. Sorry, not sorry. This is the kind of intricacies that you get to learn and love as you start trading with options.
The implied volatility or expected volatility for the stock is decreasing. So when we are trading options, it's important to be aware of implied volatility because some traders like to buy options when implied volatility is really low. And they like to do that because they think that they can make money when the implied volatility reaches higher levels. And
as somebody who used to do trading specifically based on volatility trading, I'm telling you, like it is a crapshoot. right? You really don't know. Delta is the driving force of your option price. I'm saying if you're ranking what matters, delta top of the heap by far. 70-80% of the options price from what I have, this is anecdotal, 70%, 80% of the options price is solely based on the delta move. The other, all the rest of it is all the other garbage, all your time value, all your implied volatility, everything else. And honestly, that's why I structure my trades in that way, is because I can't count on implied volatility growth. Okay, do me a favor. Let me know when the implied volatility is going to go up on the stock that I'm gonna trade next. You don't know that. I don't know that. But I know when a trend is happening. And when that trend is happening and it's 80% of what my investment is doing, that's all that matters to me. But then again, I have been on both sides of this where I have really wanted implied volatility to go up because I bought the option with that being the objective, and watched watched my trade just get absolutely monkey hammered because the delta just overran, completely demolished the implied volatility change.
On the flip side of that, traders like to short options or sell them and bet against an increase in their prices when implied volatility is incredibly high.
Never sell options. Just period, full stop. Never sell options. The golden rule of leverage trading is, and write this down, this is real. I don't know if anybody else has ever made it, but this is my golden rule in options trading. It should become like industry wide. Never put yourself in a position where you can lose more than you can make. Selling an option is exactly that, putting yourself in a position to lose more than you can possibly make. Selling a call, selling a put. Now, let's say you want to get exotic. Let's say you want to sell a put spread. Never put yourself in a position where your put spread will lose more than you could possibly make, which is how they're set up. Let's say you want to get really fancy and you do an iron condor. In fact, let's pull up an iron condor and a put spread, right? Iron condor images. Now, I got so deep into trading options early in my career that I dreamt about iron condors. Like, I was so into it. I'm telling you, like, I went all the way. You could not have taken me out and said iron condors are bad. But here's why iron condors are bad. Open image, a new tab. I want to make this way more bigger because I'm going to draw all over it. Okay, perfect example. Oh my gosh, couldn't have picked a more perfect example. This is an iron condor here. Before we get into the iron condor, I want you to focus in on the left-hand side. This is a put spread, right? An iron condor combines a put spread with a call spread. Okay, call spread looks like this. Put spread looks like this. A put spread is a bullish trade. In this bullish trade here, the absolute most you can make in this example is $100. You cannot, absolutely cannot, under anything, make more money than this $100 in this trade. However, the max loss in the trade is $400. This would be a $5 wide put spread, selling the 40, buying the 35 as quote protection. The most you can lose is 4 times the size that you can make in the trade. This breaks the golden rule of leverage. Now, an iron condor is exactly that, but with both sides. So instead of limiting it and saying, okay, if the stock goes from 45 down to 40, I'll still be profitable. But it can go to 45, stay where it is, and I'll still be profitable. It can go up over anything, and it'll still be profitable. Right? Sounds great, except when it goes up to over anything, you're only making $100. That's it. Your total max gain is $100 when you could have been making tens of thousands of bucks. Now, in iron condor, you have taken what was a pretty easy trade and now really complicated this. Right? Because now you're saying I only want it to be between X and Y, between 40 and 50. You only want it to be between 40 and 50. If it goes greater than 50 or less than 40, I got problems. This happened to Chris constantly happened to Chris. Thinking I was a genius, I'm not joking. I had 84% win rates following this strategy. And yet I lost money time after time after time. Because right down here was my nemesis. This $400 happened way too often to ever make money. More circles. Yes, we need more circles. This happened so often, right? Even 16% of the time, was way too often to be profitable. I know it sounds crazy, but don't ever sell options. Ever, ever, ever. This is selling an option strategy. Okay, this is an option selling strategy. And it breaks the golden rule of leverage, which is never put yourself in a position where you can lose more than you can possibly win.
Because if you short options when their prices are extremely expensive, meaning that there's high implied volatility, if you short the options and then a few days later,
good point. Shorting means selling the calls. Going long means you're buying the calls. Shorting means you're selling the calls. I'm telling you, you do you. I don't care what you do, but I do care that you know never sell options.
the implied volatility is lower, meaning that the market is expecting lower levels of volatility in the stock price going forward, then you will make money from a decrease or shrinking in the valuations of those options. And you can do so without any change in the stock price or without any passage of time, because implied volatility changing literally means that the option prices are changing. And really important, changes in option prices are what drive changes in implied volatility. It's a confusing topic for beginners and for a lot of
I don't necessarily agree with that. It's the expectation of future changes in option prices, not the changes in option prices, right? Changes. In fact, I do. I 100% disagree with this. Because implied volatility goes into your extrinsic value category. Remember, implied volatility must go in the extrinsic value category because intrinsic is A minus B, right? This can only be done with deltas. Okay, as the delta is changing, this is moving. All right. Now, extrinsic is only place where implied volatility can go, and that is the uncertainty, right? So it's the expected changes, not the actual changes.
options traders, to be honest, that implied volatility somehow changes option prices, that this percentage is just changing and the option prices are following it. But in reality, the option prices changing is what is causing the implied volatility to change. So an insurance premium could be another analogy. If I am working out a lot and I'm living a very healthy lifestyle, my implied volatility, so to speak, or the amount of insurance premium that I have to pay for my insurance will be low because I'm a healthy individual and there's probably not a high probability that my health will deteriorate because I live a healthy lifestyle. So we could say that the low insurance premium is low implied volatility, meaning that
Let's use that insurance premium as an example. I actually worked at two different insurance companies back in the day. I worked at State Farm when I was going to grad school to get my MBA, and then I also worked at Union Standard Insurance Company in Dallas in corporate finance. No, it's in Irving, Texas, Dallas suburb. So let's use two different examples here. First example is my Tesla versus a Honda, right? My Tesla is going to have a higher insurance premium than that Honda, right? Because the Tesla has potentially more things that can go wrong. And because of it have potentially more things that can go wrong, that would be the implied volatility, right? The implied volatility of Tesla stock is going to be significantly higher than Coke stock. Okay. Now, also, let's talk about duration, right? To insure my Tesla for one day is not going to cost very much, maybe $10. But to insure my Tesla for 6 months, it's going to cost, let's use round numbers here. It's going to cost $1,000. Okay. So if we were to look at the Honda, it might cost $4 a day for insurance. And then over 6 months, it might cost $400, right? The difference in time goes into extrinsic value. The difference in the implied volatility, meaning what the insurance is covering, right? The Tesla is going to be worth more than the Honda. More things can happen to the Tesla than the Honda, etc. And because of that, that's going to cause the option price, the implied volatility, to grow. So two different metrics we're looking at here. Implied volatility, meaning the value of the two, the expected change of the two, the Tesla to the Honda. And then the time decay is how long are we insuring it? Both of those things factor into the extrinsic value. Does that make sense? Pretty deep theory.
that there is not a lot of volatility or negative consequences expected for my health. But let's say I change my lifestyle, and the next time I go to the doctor in a year, I have admitted to them that I am no longer working out, I am not eating healthy, and I'm living a very unhealthy lifestyle. Well, they're going to demand a higher premium for my insurance because now I have more risk. So there's more risk for my health deteriorating and for me to actually need to file insurance claims. And because of that, they are going to ask me to pay higher premiums for my insurance. So we could say that is high implied volatility. So the insurance premium going from cheap to expensive, that's what causes the implied volatility to increase, and vice versa. If I started unhealthy and my insurance premiums were high, that would be high implied volatility. But as my characteristics changed and as I became healthier, I could pay less money in insurance premiums, and we would call that lower implied volatility. So the insurance premium going from high to low is what causes the implied volatility to decrease. I left a video in the description below where I do my deep dive into implied volatility, and so you can learn about it in depth. But I'm not going to dive deep into it here because that would add probably another hour or 2 hours to this video, and it's already been long enough. So if you made it this far, congratulations. You have learned so much about options trading, and honestly, I'm giving you all the information that I've learned over the past 7 years, and I am packaging up all of my aha moments for you so that you can learn basically the most important options trading concepts in just a few hours, and all those light bulbs can turn on for you much faster. So I really hope all these explanations and examples are really helping you understand how the world of options work and operate in the real world. We've got a couple more topics to go through before wrapping up this video.
All right, cool. So his next topics are exercise and assignment, expiration automatic assignment. That's actually a really good topic. Options are rarely exercised. Which options to trade? Example stocks, products with great option markets. Tastyworks, now Tasty Trade offer. Go get a free something. And then platform demo. Okay, cool. So really good stuff. We'll pick this up again next week. There's so much to learn with options, right? And I don't want you to ever come into the market thinking that this should be a hobby, right? A hobby is something that you spend money on, right? A hobby is collecting fancy things, right? A hobby is having a 3D printer that you have to constantly, buy filament for and replace parts and things like that, right? Trading is not a hobby. Trading is supposed to pay you, right? What else pays you in your life? What else pays you in your life? Probably your job, probably your investments, right? Don't treat trading as a hobby, because a hobby is something you pay for. Treat trading as a business. If you were an entrepreneur, okay? Once you trade or treat trading as a business, completely changes everything. Completely changes everything. All right, I want you to, because we are going to jump over into the other stream right now and work on today's trading plan for the replay that'll air later on today for the OVTLYR trading room. So go ahead and close the stream and move over into the other one. I'll see you there in just a moment. Talk soon.